Hello. If you followed my channel for any amount of time, then you know that I talk about a grid trading strategy that I use quite a bit. But I've never really gone into why. I'm Robert and welcome to my channel. Let's get into it. The grid trading strategy I use is a floating grid. It's taken me roughly 6 years to develop this technique. And unfortunately, quite a bit of real money losses along the way. But it has been worth it because I have perfected it. But why? Of all the different choices of trading on the market, why did I choose grid trading? Why not Bollinger RSI, MACD RSI, or countless of other combinations of indicators that are proven to be absolute winners in the long run? That question really goes back to when I first started learning about the markets in my teens. When I first started learning and I started watching how the markets played out, I started developing ideas about how trading principles work, how the markets work. Then as I grew older and became a career programmer, I continued to follow the markets, but not as heavy. At least not until roughly about 9 years or so ago, when I actually got into trading as a participant, not just a spectator or observer. And I observed a lot of things actually getting in the market myself. I observed how different it was from just being a spectator to actually placing and figuring out my next trade strategy. The indicators were a wonderful way of going about figuring out what I needed to do. Moving averages is really one of my favorites because it at least gave me a long-term way of looking at the market where I could get an idea visually of whether the market was going up or down and try to figure out what I wanted to do from there. So being the programmer that I am, I thought about coming up with algorithms to help me find the best point to get into it. That is, to get into the market or to get out of the market. The realization, though, is the more I built the algorithm, the more complicated it became, the more problematic it became, particularly when I actually started to implement the algorithm and something would go wrong. The exchange would go offline, a connection would be messed up between my server and the broker, just something would break. And my complicated, highly optimized algorithm that made me $300 in 2 days would blow up and cost me $600 because it couldn't stay connected for some unseen reason. Basically, the real world had something to say about it, and it wasn't nice. That's when I began to realize I needed something that I could actually trade if the thing broke. If the algorithm broke, meaning if my VPS went offline, if my connection got screwed up, I needed a way of being able to quickly look at the chart, figure out what was going on, and not go through 20 different equations in doing it. And that was really the beginning point of my strategy. I'd studied grid trading over the years in terms of the basic principles of it, but I never liked the fixed upper layer, fixed lower layer, because the markets move. Eventually, the markets are going to move out of that range and your losses are going to be cataclysmic at best. So that was always a problem. But something about grid trading just attracted me. Its ability to weather the market when it was in range was phenomenal. Its ability to mitigate risk was phenomenal. Its ability to take small profits at opportunities was incredible. But the range, my God, when it left the range, it was an abomination. So that got me thinking, what if I could make the grid float? What if I could cause the whole system to move with the market? Not trying to avoid losses, but being strategic about when I took my losses. That was my beginning point, my realization that I could build something I could actually do if the machine broke. I could follow this. It's easy. Even with 144 trades, I could actually follow this. I could tell what's going on. So if it became an unholy nightmare, I could actually see what my trades are doing. And I could figure out how to manually continue what I started. That is what really attracted me to grid trading. It was simple enough that I could do it repeatedly, over and over and over successfully. It didn't require layers of algorithm that would break if the world went upside down. So what you see is a system I can actually physically maintain. I don't have to have the perfect entry point. That was a critical problem with my algorithms. My algorithms required a very specific entry point, and if I missed it, I missed the opportunity. And I would have to wait until the next opportunity. A good example on the chart we're looking at is right here. An algorithm would look for this particular point on the market, see it, and get into it. But it would go through 20 different equations to identify this point. My brain does not work that fast. But the algorithm could get in and get out and get a nice, tidy little profit. But if it didn't get in at the right time, meaning if it got in up here or up here, it could potentially lose money. So the algorithm was a great way to go, but it was too complicated if something got in the way of me being able to maintain it. Meaning the VPS went out, communications went out, just some weird random life event happened. And I had to figure out 20 levels of mathematics in my head. 20 levels of mathematics that basically took me 6 months to write. That wasn't a realistic situation. It wasn't something I could do on a regular basis. And in trying to actually do so, in trying to repeat my algorithm, I caused more losses because I couldn't get the entry points as precise as the algorithm. I couldn't sit there and watch the market 24 hours a day, 7 days a week, which is what the algorithm did. So in progressing from that knowledge and those real money losses, I continued formulating my process, thinking about how I could build something I could maintain, how I could build something that no matter what happened, I could figure out what was going on. I could continue to buy and sell, making the algorithm work until I could get the program back online. or whatever problem was wrong with the program was fixed. If it was, for example, a communications error. This is the biggest learning curve I have actually been through in my journey as an algorithmic trader. And that is realizing that algorithms, the more complicated they are, the more moving parts, that makes them harder to actually maintain and easier to break. That's not to say that the perfect simple indicator isn't still going to break no matter what. But at least, providing you can get to the machine, at least you have a way of continuing the process. At least you can actually take care of trades. You can either enter a new position or exit a position that's in profit. You have a way that you can build on, that you can maintain control on without the algorithms behind it, because they're simple enough that you can follow them. That is really what drove me to spend 6 years building on a grid bot, building on a grid trading principle that focuses between two ranges. In the case of the screen, the two yellow lines are the ranges I have been looking at, I have been monitoring. And those ranges give me the definition of what we see on the screen. But at 144 positions, I can maintain that if the bot breaks. It definitely won't be as fast, but I can still do it. I can trade this manually, continuing to get profits and enter into new positions as the market moves. The process is easy enough that I don't have to spend a lot of time running through unholy amounts of mathematics. And I chose this particular account to demonstrate just how complex the process can be, and yet just how easy it is for me to follow. 144 open positions is a lot of trades to handle. But because of the way I built the algorithm, I only have to focus up here. Here it is. Either this entry is in profit or not. If it's not in profit and the price has gone above this entry by a certain distance, I buy another position. I don't have to be perfect in my entry point. I don't have to worry about skips and jumps, or if I magically hit the right point on the candle. It makes it easier for me to control. When I have to take a loss, that's also easy to figure out. My losses are exact and precise. If I have to take a loss, then I take my loss down at the bottom. Something I can reproduce, something I can track, something I can test, something I can take action on easily. I have a framework that makes rational sense. That is the whole point of why I built this particular strategy. Why I spent money testing and losing real money getting it right. Because I could build easily and efficiently something I could follow if it broke. So let's get into a few of the charts. For example, equity, trades, things that matter for the algorithm. Looking at the equity chart and seeing how it unfolded. Right here we can see how stop losses took care of the situation. Now this is ran by the algorithm. It did this automatically. I didn't have to worry about it. it made it to an $8,000 profit, stop losses of 2,000, and now have roughly 7,000 in terms of my current profitability. That's not bad. Not for a passive system that doesn't even try to time its entry points. And that's the whole point. That's what makes this system so unique. You don't have to be perfect with it. That's why it's critically important in terms of understanding its success. It works because it's sloppy. It works because it's not perfect. But when we go to and actually look at the number of trades per day, some of them are obscene. For example, we see right here, almost 250 trades in a single day. The volatility for this was just unbelievable. But if we zoom in to the more recent period, we can see just how many trades have taken place. I cannot physically match this. There is no way I can sit here and make 200 trades in one day. Just isn't happening. But that is what gives algorithmic trading its strength. The computer can sit there and make 200 trades in one day and do quite happy about it. And you can even see on the chart specifically my stop losses by the blue bar. The computer can do this wonderfully well and really take it home. And that's why algorithmic trading has such a huge advantage over discretionary, manual, or human-done trading. I can't sit here and watch this. Somewhere along the lines, I've got to eat, sleep, and, well, live life, or try to live life. But the program can sit here and do just that when it's running properly. But let's take this one step further and look at just the magnitude, scope, and scale. We can see the numbers here. They look crazy. The idea of 250 trades in one day is really just remarkable. But let's see it in actual trades. Let's see what those trades really look like. Now this chart's going to take a few seconds to load because, well, it's got a lot of stuff on it. It's got a lot of trades on it. So let's see if it loads quickly or if I need to do a cut. Okay, I ended up doing a cut. But here it is. All of the trades I've taken on this account through the algorithm. The greens are profits. The reds, like right here, those are stop losses. The light blues, those are my reductions. That is where I deliberately give back a little bit of money on each trade. I reduce the oldest position, burning it off. So, as we can see, that's a lot of trades. There's well over 4,000 or 5,000 trades on this chart. That's a lot. That's something that I just would never be able to do by hand. But it can, and it's done a good job putting me $7,000 into the good. But that brings up the real world question of what's it like trying to trade this strategy by hand. Let's actually find out. Okay, we are looking at my automated bot. All of the trades are done by the program. This is done by the machine for me. But I have two pairs that I am actually using the same technique manually. That is by hand. So let's go to the first pair. Okay, now that I have the right pair, here is my trades. I've placed these trades by hand. Notice there's a lot less here. I've only got 6 trades. This is all I have on this account, or on this pair, excuse me. 6 trades. Now these trades don't have a good leverage. It's only a 10-to-1, so you see the position sizes are reflective of that situation. But that is the whole point when you look at the market. For example, you see I have $60 in margin used, and right now it's $23 underwater, which is fine. I don't have to worry about this account right now. It is well within its safe limits. My margin is only at 8% right now. That's it. And all of the positions I have open are 47. So right off the bat, take off 6, and that eliminates just this asset here. So I could sit and let this work and worry about it over time. But that's the advantage of it. Every one of these trades was placed by hand. I opened up that trade manually by selling or opening a short position. And then I placed a take profit line at roughly 73 pips below what my open position was. Basically 73 cents per position with this particular asset, because it only has a 10-to-1 leverage rate. But if I go to my other pair, which is a 50-to-1 leverage rate, you see it has a whole different system. I only have 3 positions here, and my take profits are set to $3 a pair. Now I am $2 underwater, and I have basically $32 at risk, or $10 roughly in change per position. Now the green lines on the chart, these are my take profits for $3. But again, well under my risk level, because there's no way I can trade at the level of the machine. But that being said, my profitability is far less than the machine. Again, that's why algorithmic trading is so powerful. I can magnify those profits drastically compared to what I can do on my own. Albeit, my position sizes are slightly different and my profit levels are different. Here I am taking roughly a 30% profit to make up the difference of the trading frequency. But it's still a viable solution. It still works. That is absolutely critical. So when you're building your trading approach, when you're actually getting into algorithmic trading, and you want to take and automate what your technique is, think about what happens if the machine breaks. Can you maintain your trades manually? That is the big question. If the machine breaks and I have to take over this by hand, I can. I can follow what I'm doing. I don't need a lot of time to look at the chart. I can see how it's structured. It makes sense. I can open up a new position and not worry about where the market is or if the market is at a specific point. That's important. That alone is why I recommend grid trading, because it doesn't require complication. It doesn't require perfection. You don't have to be perfect on when you get in the market. It makes it easy to learn as long as you keep your risks low. So I encourage you to look at different techniques. Study them all. There are some favorites like the MACD, Bollinger's moving average. I love those indicators and I use them constantly. But when I want something I can rely on as the staple of my trading, I want to make sure it's simple so I can always follow it. I can always get in the game and take care of any problems. This is the biggest, most critical lesson I've learned in my trading career. Always, always, always be able to trade your own strategy. If you can't trade it, or you can't figure out where to get in or get out, it's not going to do you any good to even have it. Always trade your strategy by hand first. First and foremost. If you can trade it by hand, then try to automate it. If it's simple to follow, then you can follow it. But if it's not simple, or it's not easy to see right away where you get in and you get out, then you've got a problem. You can't easily decide when to deal with the market. Here's an example of a chart. It's got a strategy on it from Jackrabbit TV. I can easily follow it. I can easily see how to get in and out of the market just by these little markers. Buy, sell. So I know how to actually control and maintain the strategy. This is the important part. Always have a way of being able to figure out what you're doing. Now, this type of a strategy does have the downside that if you don't get into it exactly at this point, meaning if you zoom in and you actually get into it up here, your profits are going to be less, or they're going to need to be refactored. That's not that difficult, but it still could cause losses if you don't pay attention to the timing. For example, if this particular point in time occurs when you're not near the computer, it's a lost opportunity. But it's still not impossible. It's still not something you can't do. So if you miss it here, you could get into it here and still get reasonably good profits. That is the whole point that needs to be taken into account. There is a way to be able to still take this kind of a situation and be able to manually take over if you have to. So let me know what you think. Is your strategy something you can trade easily? If the machine breaks, can you step in, take over, and continue making profit? Share your thoughts. Leave a comment below. Let me know. Thank you for watching.